1. Fibonacci and gap analysis. Fibonacci retracements. The Fibonacci retracement is a technical tool that plots horizontal lines based on key Fibonacci ratios. These lines serve as potential support and resistance levels. To apply it, identify a distinct swing low and swing high on your chart and drag the tool between them. Traders typically wait for a pullback to these levels, most notably the 0.382 level, as it is a frequent reversal point. While the 0.382 is popular, price can react at any Fibonacci level, so it is best to combine this tool with other confirmation signals for a higher probability entry. Fair value gaps (FVG). A fair value gap occurs when a candle moves so sharply that it creates an imbalance between buying and selling pressure. To identify an FVG, look for a large-bodied candle. Draw a rectangle covering the gap between the wick of the preceding candle and the wick of the following candle. This zone often acts as a magnet, where the price is likely to return to fill the imbalance before continuing its original direction. 2. Chart patterns and market movements. Breakout patterns. A breakout occurs when the price makes a sudden, forceful move in a specific direction, usually following a period of consolidation, sideways movement. To anticipate these moves, traders look for specific structures like wedges, triangles, and rectangles. Identifying these patterns early allows you to enter the market just as the momentum shifts. Reversal patterns. Reversal patterns signal that the current trend is exhausted and the price is likely to head in the opposite direction. Recognizing these helps traders predict a trend change before it happens. Famous reversal formations include double tops and bottoms, triple tops and bottoms, head and shoulders, cup and handle. 3. Advanced wave and geometric theories. Elliott wave theory. This theory suggests that markets move in repetitive cycles of 5 waves in the direction of the main trend, followed by a 3-wave corrective set, ABC. By labeling waves 1 through 5, traders can forecast future price targets. Key rules for a valid Elliott wave include: Wave 2 cannot retrace more than 100% of Wave 1, often pulling back to the 0.618 Fibonacci level. Wave 3 is typically the longest and never the shortest among waves 1, 3, and 5. Wave 4 must not enter the price territory of Wave 1, often pulling back to the 0.382 Fibonacci level. Gann angles. Gann angles use geometric angles to measure the strength and timing of a trend. To apply them, you must lock the price to bar ratio in your settings, identify a market range, and draw a 45-degree angle, the 1-by-1 line. Price moving within steep angles indicates an aggressive trend, while shallow angles suggest a weak trend. The various lines in the Gann fan act as dynamic support and resistance. 4. Specialized chart types and indicators. Heikin-Ashi. Heikin-Ashi is a modified candlestick chart that filters out market noise to provide a clearer view of the trend. Green candles signify an uptrend, while red signifies a downtrend. The candle size represents trend strength. Larger bodies mean stronger momentum. Note that Heikin-Ashi displays an average price, not the precise current market price. Renko charts. Unlike traditional charts that form candles based on time, Renko charts are based solely on price movement. A new brick is only formed when the price moves a specific distance, for example, 1%. This is excellent for trend identification and removing minor price fluctuations. Like Heikin-Ashi, it acts as an indicator and does not show the exact live price. Harmonic patterns. Harmonics are advanced patterns that use specific Fibonacci measurements to create geometric shapes like the butterfly, bat, or crab. For example, a bullish bat looks like the letter M and requires specific ratios between points X, A, B, C, and D. When a price structure matches these precise guidelines, it offers a highly technical entry point. 5. Momentum and trend indicators. Momentum indicators. These tools measure how fast prices are moving and the strength of the current trend. MACD uses crossovers to signal shifts. Upwards equals bullish, downwards equals bearish. Moving averages, a simple trend filter. Price above equals bullish, price below equals bearish. Parabolic SAR uses dots above or below the price to signal trend direction. Super trend, a color-coded overlay providing buy, green, and sell red signals. Oscillators. Oscillators are best used in choppy or sideways markets to find overextended price points. RSI, Relative Strength Index, signals overbought, potential reversal down, or oversold, potential reversal up. Stochastic. Uses two lines to identify momentum shifts and overextended conditions. Divergences. A divergence occurs when the indicator, like RSI or MACD, moves in the opposite direction of the price. For example, if price makes a higher high but the MACD makes a lower high, this is a bearish divergence, warning of a potential downward reversal. 6. Volume, supply, and demand. Volume indicators. Volume tells you the conviction behind a price move. Price volume shows the amount of trading activity per candle. VWAP, volume weighted average price. The ratio of price to total volume, often used as dynamic support/resistance. Volume profile displays volume activity at specific price levels horizontally, highlighting where the most trading occurred. Supply and demand, order blocks. Supply and demand zones are areas where institutional order blocks caused massive price shifts. Demand zones, areas where price shot up aggressively. Supply zones, areas where price dropped sharply. Traders treat these rectangles as golden zones for entries when price eventually returns to them. 7. Market structure and price action. Core structure. Market structure is the study of price flow. An uptrend is defined by higher highs, HH, and higher lows, HL, while a downtrend consists of lower highs, LH, and lower lows, LL. Break of structure, BOS, versus change of character, CHOCH. BOS occurs when price continues the trend by breaking the previous peak/trough. For example, price breaks the previous HH to make a new HH. CHOCH occurs when the trend ends. For example, if an uptrend fails to make a new high and instead breaks below the previous higher low, this change of character signals a potential trend reversal. Support and resistance, static and dynamic. Static, horizontal lines where price has historically bounced. Dynamic, moving lines, like trend lines or moving averages, that act as support/resistance while slanted or curving. Moon phases, alternative analysis. A unique concept where traders correlate lunar cycles with human emotion and market behavior. Generally, a new moon is viewed as bullish, while a full moon is considered bearish. This is typically used only as a secondary confirmation tool. Did I miss any strategies you use? Let me know in the comments. If you enjoyed this breakdown, please like the video and subscribe to the channel. It only takes 2 clicks, but helps me immensely. Check out my other videos to keep leveling up your trading game. See you in the next one.